Okay, we had a lot of swings last week, but no runs, no scores. Kind of was a interesting week. We had some big swings in market movement, but the ball didn't really go anywhere. Right, we didn't move down the field in any direction. Whether rates were higher or lower at the end of the week, we're still kind of stuck in the same range we've been in the last 2 weeks. I'll show you the chart here in just a minute. Before I dive into that, though, I want to talk about inventory and what's happening because we're now in the spring housing market, just about to get to May, which tends to be May, June, July tend to be the busiest months of the year in most markets, especially up here in the northern climates. So what's happening here in Boise? I'll talk about that and then also talk about nationally what's going on. So this information I pulled from Altos Research, really excellent site which nails it down to the zip code or the city. It's very specific. So in this case, I said Boise, Idaho in general. I didn't specify specific zip codes within the city, but this just gives a good idea of what's going on with inventory this spring and whether or not we're going to have an effect on house prices, whether prices are going to rise or fall. So here's what it's showing. As you can see, their little gauge here shows we're in a strong seller's market still. And the reason for that is actually right here on this chart, their inventory chart, showing that we are still, although we've had a little bit of an increase in inventory because we're in the spring, it's not a lot, right? We're still actually lower inventory than we were, or about roughly in the same range than we were last April of 2023, and a little bit higher inventory than we had in April of 2022, but not much. So we're kind of still stuck in the middle here, kind of roughly the same as if you go all the way back here to the spring of 2019, roughly the same inventory level. So no, we're not seeing major inflated inventory that could cause the house market or prices to crash because there's too much inventory to be soaked up by demand. And on the flip side of that, we're not showing too little inventory to where there's nothing for sale. So home prices continue to be supported at these higher elevated levels since the pandemic, which is an unfortunate new reality, especially for first-time home buyers. Of course, for those who are selling, they love it, but then you have to go buy something else, right? So unless you're going to go buy in a small town in the middle of Nebraska somewhere, you're just trading places and moving money from one house to another. So it doesn't really help you with being wealthier with your personal net worth. It just helps you be able to continue to move forward because you're already kind of in the real estate game. So that's what's happening with inventory. And on the median home price front, which is another gauge, right, to see what's going on, we are sitting, let's see if I can find it on here. For some reason, it's not pulling up. Oops. Wrong way. Here we go. On the median home price front, we're still seeing prices kind of hanging in there, roughly the same as they were a year ago. Not a whole lot of difference there. So a little above 600,000 on average in Boise, Ada County. So yeah, no drastic improvement either direction or decrease or increase. It just is what it is. So on a national level, which I kind of showed you here a second ago, here's what's going on. If you can go back to 2005, there used to be nationwide, right, at the peak when there was a lot of inventory out there, which part of what caused the crash, including, of course, the loose credit standards in my industry caused the crash as well. But there was also just a ton of inventory because there was so much speculation with people just trying to buy for an investment. And there were about 24 homes per 1,000 people for sale back in 2005. Right now, there are about 12 on the national average. The current pace is about 4.1 million existing home sales. Normalized pace for a year is 5.2 million. So we're still below that. And we've had about 40 million new people enter the country, either through birth or immigration. There's a lot more people here than there were 15, 18 years ago. So there's definitely on a national level pent-up demand and still not enough inventory, not enough supply. Much of that, of course, is locked up because people don't want to sell because they have such a low interest rate from the last couple of years. So it's going to take time. It's going to take a number of years for this to trickle out and even out over time. So that's what I wanted to give you as far as an update. I want to talk to you a little bit about housing, how that looks, whether or not it looks like there's going to be a crash in prices this spring based on the inventory levels, et cetera. I don't see it. I just don't see it. I mean, unless interest rates jump up 2-3%, which heaven forbid, hopefully they do not. If that were to happen, yeah, maybe we'd have everybody freeze for another year and we'd see prices come down. I don't see that happening, though, either. Like I said, the Federal Reserve, although they're not lowering the rates yet on the Federal Reserve front, on the federal funds rate, they do have another tool in their tool belt. And that is that they could start using the proceeds they get from maturing bonds that they purchased in the past that mature every month. This money that they get as income, the Fed can take that and repurchase new treasury bills and bonds. So they can repurchase government debt course, our government has plenty of debt to sell. That's how we're financing the majority of our operations as a country right now. So there's plenty of debt to sell, but they could become a bigger buyer by taking some of this 90 to 100 billion dollars a month in income that they get, right, in matured bonds. Say they take 30 billion of it or whatever, and start buying some of this debt. That would help keep a lid on interest rates. Might not drop them much, maybe a teeny bit, but at least help keep a lid on it. And the Federal Reserve's talking about doing that. So they have a meeting this week. They're going to be talking a lot about this sort of thing and what to do, because inflation is not moving, et cetera. So in fact, here's a chart to show you what happened last week. We had the PCE report come out on Friday. The Federal Reserve knows that inflation is just not budging. So they're either going to have to leave rates where they are at this higher levels for longer, or again, maybe increase them. They're not talking about increasing them yet, but you never know. They've gone from saying, hey, we're definitely going to cut rates 3 times in 2024 to maybe once towards the end of the year. That's kind of where they're at right now. So, you know, it could go to 0 times and it could flip the other way. It's possible. Say, hey, we need one more rate increase or whatever. That is possible. They're not talking about it yet, so I'm not going to like throw cold water on the party. They're not talking about that, but it could potentially happen. As you can see, the core inflation rate, which is what they watch on the personal consumption expenditure report, PCE, went from 2.82 to 2.8, well, 2.84 to 2.82. So it's the same, 2.8. It didn't move. That's that core piece that excludes food and energy. The headline looked worse. It went from 2.5 to 2.7. Looked like it went up a little bit. And that's mostly because of increased energy prices, increased oil prices over the past month, to 6 weeks. So that's what happened with PCE. Not a whole lot of change, except for that headline, which was worse than we expected. And then remember last week, I talked about the fact there were a lot of bonds coming to auction. We had 3 days of record bond sales. Those were absorbed. Not great. Tuesdays was better than expected. Wednesdays and Thursdays were kind of like C-ish. If you grade it A, B, C, D, is kind of like a C is what they got as far as auction results go. So they were okay. At least they were, most of it was mopped up without having to increase pricing too much, but it wasn't awesome. So that's what happened last week. This week we have the Fed meeting, and then Friday we have the jobs report. So a lot going on, a lot we could expect to see as far as market movements. And especially with the jobs report, right? Our unemployment rate's at 3.8%. If that does not increase to 4% or 4.1, there's nothing in the inflation that's going to cause the Fed to want to lower the federal funds rate. If there's nothing on the unemployment side or the unemployment rate that would cause them to drop rates sooner than later, we may be stuck in this situation a little bit longer than expected. So here's what's going on with the charts. You want to take a look at this. The 10-year Treasury is a leading indicator of the 30-year mortgage. That is coming down a bit. The yield has come down the last couple of days since Friday and today. There's still a lot of room to go down even further to get to the 25-day moving average. So that could be good. This is a leading indicator, right, of mortgage rates. So we'll see if that comes down based on what commentary comes out of these Fed meetings. The universal mortgage-backed security 30-year is the opposite. This shows the price. And so as you can see by the title of my video here, right, there's been a lot of swings, literally a lot of large swings the last 2 weeks based on daily data, but not a lot of movement, right? We haven't gone anywhere. We're still in this wide range between these two Fibonacci levels of 99.64 and 98.86 or 87 on the bottom. We're hoping for a breakout up, of course, to get up to this 200-day moving average at some point very soon. So hopefully there's some data that will allow that to happen in the bond market to say, oh, okay, maybe we don't have to worry about, maybe we can look forward to lower federal funds rates sometime in the near future, and get a slightly better pricing this week. But there's plenty of room the other direction as well. So we're kind of stuck kind of in the middle. Hate being in that position, but that's where we're at, waiting for more data. Okay, so that is really in a nutshell what's going on and what to expect this week. Again, Federal Reserve minutes, watch for that to affect markets. Friday's jobs report, watch for that to affect markets. I'll be back on next Monday.